I worked with them. I was an investor in the company. I know what the fuck was going on.
Right, so
They were negotiating with Intuit before the DAG round. They built that company on less than $3 million.
I've got some.
I love it. This discussion is getting really, really interesting.
I've got some slides. And you get I've got some slides you guys just set up perfectly. Can you turn those on?
Probably some real information coming.
No. Okay. All right. So there we go. So you know, new paradigms are always a challenge, and in Austin we have lots of lakes. So this is all the pictures are my own, and these are friends of the family. But anyway, so the paradigm shift now is that you kind of have different levels of funding for your startup and for your venture that you need to really think long and hard about. So calling angels where you're getting 50 to 100K, sort of a rowboat, or super angels like us, $500,000 to $1 million investment, and maybe syndicating a bigger round, maybe more of a speedboat, and then the big stalwarts of the industry, the tankers, right? And there is a place for everybody in the market, and it's synergistic.
That is true.
And it is synergistic to have all these groups in the market. So, but what you don't want to do is crash out of cash or drown, in dilution. And you heard a great story about some of the founders who, when the company went public, they had such small amounts of capital available. I mean, small amounts of equity left. They'd just gotten hugely diluted over the course of building the company.
Still a good story, but yeah.
Still a good story, right? So for the entrepreneurs in the crowd, I'm kind of bringing it back down to micro level. Jump on the right boat and really make things fly, and be thoughtful about the amount of capital you're trying to raise, and about the business model that you're in, and about how much money you need to raise to be successful. So little commercial for us. We used to be called seed angels. Now we're a super angel. My Twitter handle is Texas Super Angel, because usually I'm the only Texas guy that shows up anywhere. But it's all together. We work with angels, and angels will provide some of the earliest stages of funding for some of these companies, and then we'll jump on funds that are a little larger. And there's funds out there that want to deploy $500,000 to $1 million to $2 million, and there's also angels out there that want to deploy $500,000 and $1 million. So we're working on a term sheet with a company out here right now this week, and they have they've got a couple of $1 million circled from angel investors, very notable angel investors here in the Valley, but they don't have anybody to put the term sheet together, to price around, and to package it in a way where it makes sense. And making sense means a good round for the company, good round for the investors, and having it structured in a way that when you are successful, you can reach out to the bigger firms, and they walk in and they check all the boxes, and you've done all the blocking and tackling to where your startup is in just a perfect, in the starting blocks to take on $5 or $10 or $20 million of capital. And we've raised those kinds of amounts of capital for our startups in the past. We've also sold our companies. Our median time to exit is 3.5 years. And our exits have been between 15 and $80 million. But they tend to happen, fairly quickly, and they tend to happen, regularly, a little more consistently. So, I just want to try to remind the entrepreneurs in the crowd to really focus on what your model is, how much money you think, and work on it, and spend time talking to smart people about how much capital you think you really need. Another phenomena that's happening is that in some cases, we'll get involved with a company, and maybe we'll invest the first $500,000 after, along with some angels, but we'll structure the round to take $1.5 million or $2 million, or whatever the optimal amount of capital might be. And Naval talked about it a little bit in sort of the continuous funding model that he was mentioning, and that is starting to emerge, and we're kind of embracing it, and we think it makes sense that if we have faith in the team, the concept, and the market, let's give these people some money and turn, rev the engine quickly and let them gain some traction. And guess what? If we land a strategic partner, all of a sudden have phenomenal success in our key metrics, if it's only happened in 3 months, maybe we should let a couple other people in for $500,000 or $1 million and really turn it on. And then the next jump, maybe the next jump is a $10 million raise or a 15 or a 20, because there is a bit of a bubble that's starting to happen, and I think there's a debate about whether the 5 million round is dead. Is the new B 10 million, and is it after kind of 3 to 5?
How about Color raising 41 million in Series
Yeah,
A?
let's jump in on that.
Yeah.
It's officially a bubble, 41 million
41
for
million.
first round. Actually, we were having a conversation about this last night. We were wondering, did the founders take money off the table in the very first round? Is it possible to take money off the table in the very first round? Yeah, because, well, I mean, that's what's happening in B round. Basically, they just went right out of the gate with a big ass B round, right?
Yeah.
And so typically most B rounds that are happening, so this is what I was saying as far as, I think for most founders, somebody wrote this as the Patzer problem, that was the tech wrench.
Oh, yeah.
So the Patzer problem from the VC perspective is $50 million is easily life-changing money for a lot of entrepreneurs. Probably $10 million to $20 million is life-changing money. So the $75 to $100 million exit, even the $50 million exit, is extremely attractive to founders who own a significant percentage of their companies, which is much more the case, right? All those production costs came down, capital efficiency, right? So the Patzer problem is for big VCs, how do you encourage entrepreneurs to swing for home runs? And the way that's usually done is when they raise the B round, they probably provide some founder liquidity, maybe $1, $2 million in those cases. You guys don't like to talk about this, right?
No, I mean, I'm happy talking about it. I think what we tell people from the very beginning is it's all about goal alignment.
Right, absolutely.
And there are a lot of people that I simply tell them you don't want to raise a venture round. Because the problem you get, too, is if people have cashed out $10 million, what motivation do they have? And your goals are no longer aligned, right? And so when you're looking at an angel round and you're taking in, say $500,000 and a 10x on that, $5 million, if you're good with that, that's perfect, right? Your investors will be happy and you'll be happy, okay? And there are many, many companies out there where that is where the point at which they should stop raising. And I tell a great number of people exactly that. You've got an interesting business. I think I would scale it organically, and there are a lot of people that might buy you. There's more cash on the corporate balances than since 1957 right now.
Yeah.
So it's all about optionality. So when you pony up and you say, I want to do a Series A, I want to bring in $5 million. Well, then you know what? You've signed on the dotted line for a $50 million exit, right?
Or more, probably,
more.
right? Probably more like $75 to $100 million.
Yeah, and then beyond that.
Can you do the math there for them? Like, I think that's illustrative to really talk about, right?
Yeah, I mean, well, I think a 10x is people will be very happy with that. I would know. I mean, yeah, so 50.
But you're raising
But
5 months.
5 on 5.
Yeah.
5 on.
Yeah.
okay,
5
well,
on
that was
5. Then you're
That's
yeah, you're right.
100.
Then you're at 10. Yeah, so then you're at 100. You're totally right.
right.
And it just ratchets up. Yeah.
I certainly hope no entrepreneurs in here are taking 5 on 5 deals. That would be really foolish in my opinion these days.
Yeah, a lot
Okay,
of
well,
companies
I was thinking that I was 5 on 10 if you're an asshole VC, and 5 on 15 if it's a hot deal and it's a generous. But let's just say, so on a $5 million round, I think the post money is probably 20, right? When we say pre-money, it's the valuation before you put the money in, plus the money that's in. Post money is the total. So $5 million round on, let's be generous and say it's $15 million pre, $20 million post. Probably minimum 3x to 5x return expectation.
Right, but you've got to believe as a venture capitalist will be 10.
More, she's saying more, right?
I think
Well,
more.
I think, yeah, so I mean,
Would you
for us,
tolerate an exit at 3 to 5x?
Well, yeah,
You wouldn't,
depending on-
let's say, you
depending on
wouldn't
how dicey
block,
it is, tolerate
you wouldn't
it.
block an exit at 3 to 5x.
Right, but here's the way we think about it,
Sure.
is we do multiple stages, is early stage deals you have to have easily, you have to really believe it can be a 10x deal because the death rate is really high. The risk is high, so of the
So
deals
let's
that win.
rephrase, the death rate is really high is we're shitty investors, right? We hit really poorly. That's why the multiple has to be high. If we hit better, the multiple would not have to be quite so
Of
high.
early stage, the stats are that very few of them are positive exits. And
I
a
agree
small
because
number
you're
of
generally
them-
aiming for $500 million to $1 billion
Yeah, so-
exits, but if you're aiming for $100 million to $50 million exits, The batting average
Can you let
might
her
be.
talk, Dave?
Yeah, exactly. Okay, we're gonna take away your mic. But anyway, you have to have, so the way the averages, the way the averages work out in venture capital is that typically the winner deals of early stage deals are 10x's or greater. The winner deals are spectacularly higher than that. But the good quality winner early stage deals are 10x, which if you've only invested a couple $1 million doesn't have to be that big.
I really can't
But-
interrupt you right now.
No, you can't. So
10x is good. Nothing less than 10x is good.
No, I didn't say that. I said the really winner deals that make up for the losers and the so-so winners, right? There's duds, mid hits, and hits. They all have to average out to what the LP
Sure.
wants, which is around a 3x fund, 3.5x before fees, cash on cash. Like
Right.
that's all they're really looking for is 2.5 to 3.5x cash on cash return. Okay, so if you have a high risk, meaning a high risk of the not returning capital, you need a 10x on the winner deals. We think of it as mid-stage deals. When we invest in a company that's doing something like, $4, $5, $7 million in revenue, we are looking for a base case 5x return on that because some of them will do better, some will do worse, and if on average you think you're gonna get a 5x return, and not that many of them died, you'll end up again netting back.
So
3x
Sharon,
return.
let me add
Yeah.
something to that. I think this clearly reflects everyone's perspective based on the philosophy of their investment or their firm. And in your case, it's clearly a mid to late stage investment firm, and you're looking for deals. That's the philosophy that you follow, and that's fine. So it basically what it tells us all is that there's a need for each category of investment out there. Now the question is, which category is the faster growing category? Now, we can either let the audience make their decision on that and say, well, these are the trends that we see out there, and we think that this part of the market is shrinking, or this part of the activity is shrinking, or perhaps that's not the case. Maybe all of these are growing, but I think some of the stats that we just discussed say that there's been some big changes out there. There hasn't been much change, or there hasn't been much of a drop in terms of entrepreneurial activity. There's a lot of entrepreneurial
Quite the
activity.
opposite. The
Yeah,
entrepreneurial
no, the
activity is off the
entrepreneurs-
charts.
yeah,
Right, so
Much larger
which
group
means
of
that these companies are still able to get what they need to get incubated and get to a point where they can go to people like Rebecca and ask for more money, and then eventually to mid to late stage VCs as well. So from that perspective, I wanted to get into what else has changed out there. The amount of entrepreneurial activity is going up. I think Dave touched on the ability to do much better quality distribution has really improved over the last several years. So those are some fundamental changes. That's definitely not cyclical.
So I think that's
the cost
why we
of
think we
building a
have all-
company is much lower now. So how do these factors play into how we all think about these different stages of investing? So and based on that, let me start with a question that how do each of us at our different stage in the food chain look at the other guy who's investing at a very early stage compared to us, and see how does a very early stage or seed stage investor contribute to what I'm doing? What's the relationship over there? I don't think there's necessarily a contradiction. There's probably synergy across all of these different categories.
We all work together a lot more than we
Yeah.
compete.
No, I mean, as a Series A investor predominantly, I think it's great. So we were actually worried when sort of angel investing went away for a while about what we were going to do, because a lot of the quality went down, people weren't starting companies. I actually had a thesis back when the crash happened that now would be a great time for people to start companies. And I had expected to see a lot more of it earlier, and I think people froze to a large extent. I was at Berkeley in the engineering school, and the engineers, to my dismay, at that point in time when everything crashed, I thought they would think the opportunity cost was lower for starting companies. They would naturally do that. And they didn't. What we saw in that class was they actually were fighting over the big company jobs for stability. And it took about another year for the entrepreneurs to really come out and really get aggressive. And so for us, I think we were excited about all of the activity in series in the early stage and the seed stage, because what it means for us is a large crop of companies that then the ones that it's right for and the ones that do want to take it to the next level, we can work with.